Marinero, the Sick Podcast. Today on the Sick Podcast, a little bit of a different show than shows you may have been accustomed to. We talk about professional athletes every day, the contracts they sign, the money they make. And sometimes, and actually it's happening more and more often over the years, you hear stories of athletes who are broke. And you say to yourself, how the hell did this happen? They earned 50, 60, 70, 80 million dollars over the course of their careers. How can they be broke? A couple of gentlemen are going to tell us how easy it can be and what they actually can do to avoid it. I bring in Stephen Furtado, investment advisor with Manville Private Client, and Laurent Massa, VP, Family Office and Advisor Relations, Head of Sports and Entertainment Division at Group RMC. Gentlemen, how you doing?
Good, Tony. Thanks for having us on.
Good, Tony. Thanks for having me.
You're very, very welcome. All right, guys. So I imagine you guys work together and help each other. Stephen, why don't you tell me what you do? Then Laurent could tell me what he does. And then I guess we'll figure out what you guys do for each other.
Right. So I work in wealth management, and I serve high net worth families across Canada and North America, basically.
Laurent?
Yeah, so I'm part of a real estate co-investment group. What that means is we're essentially just a bunch of families who get together and we buy real estate in the U.S. And parallel to that, a few athletes have come in our deals because for separate reasons than these families, real estate can be a very good fit for them.
All right. So now if I was a professional athlete, which unfortunately never happened, but if I was, knowing what I know, this is what I would do. I would try and buy as much real estate as possible, because less money I have in my bank account, more property I have, at the end of my career, I will not have spent all my money, and I'll have some apartments, I'll have some doors, I'll have some rents to fall back on. Isn't it that easy? Laurent, I'll start with you.
Yeah, yes and no. It is that easy in theory, but a lot of people don't know where to look. Athletes or no athletes, it's not very easy to just get up and do a real estate deal. There's a lot of heavy lifting. You got to, secure loans. You have to find a deal and all that kind of stuff. So I agree with you that it's a very good fit for athletes. I'm not sure if I would put every single dollar I have in real estate, because it is a bit of what you call an illiquid asset, meaning it's not something you could just sell tomorrow. But the idea is good. I mean, athletes, have such a short earnings window. If you're lucky, you're earning for the first 10 years of your working career. If you could take some of those earnings and turn those, convert those into income early on in your career, so that when you're done playing, whether it's 3 years, 10 years, 15 years, you have money coming in no matter what. That's it's a good security net.
Yeah, I was going to say, Tony, that, even Warren Buffett said, investing is simple, but it's not easy necessarily. So, just dumping your money into real estate, it would be a great plan. I'm sure a lot of these guys would have benefited from doing so. But I guess part and parcel as to what I do and how I work with Laurent is exactly this. Somebody comes into money, and now what do we do with it, and how do we make sure that we don't outlive it? So that's kind of what we wanted to bring to the audience today, is kind of say, listen, what's behind the scenes now for these athletes? How are they investing, and what's the trend right now? Like what's helping them get through or break this statistic of, I think it was Sports Illustrated or whatever that brought out this crazy percentage of athletes that go broke within the first few years of retirement. So how do we break that stigma?
Laurent, so a real estate portfolio is what you have, or different portfolios? How does it work exactly?
Yeah, so traditional real estate companies or private equity funds, they're kind of set up in a way where they'll buy real estate, they'll pull together a bunch of investors, and then in 5, 7, or 10 years they'll offload it, and then they'll take a 20% cut of the profits, and they move on. They got to find another deal. We take a much different approach. We're what you call permanent equity. What that means is basically you treat real estate the way it should be treated, which is as what we call a permanent asset. Warren Buffett calls it buy and hold. So we get a bunch of people together, a bunch of families, we pool our money together, and we buy the same type of real estate that these big shots are buying, except we don't have a false timeline, an arbitrary timeline 5, 7, or 10 years down the road where we have to sell to make a profit. We're perfectly comfortable just sitting on the real estate for years and even generations. It's not that much more complicated than that. The heavy lifting, like I said, is done on our end, where we have to find a good deal, we have to do our due diligence, and then we turn and offer it to our families. And if they like it, they come in. If not, they wait for the next deal. Athletes, I think, have generally liked investing in something that's tangible and something that is, at the end of the day, a pretty simple business compared to all this nonsense you're seeing out there that nobody can explain. And it's for that reason it's a good fit. I always like to say it's the type of stuff that team owners invest in, and a lot of athletes, especially in baseball and in basketball, and some football guys are it's not a stretch to say they're making owner money. And so why shouldn't they have access to that type of real estate? Why shouldn't they rub shoulders with them and come and see the assets and do the type of deals that they're doing? Just because they're athletes, I mean, they're professionals. A lot of people most people aren't professional anything. So that's sort of the vision, and that's how the process plays out.
So, Stephen, in the line of work that you do, you obviously meet with people every day that want to invest money. And at times you're going to meet with athletes, or you're going to get referrals, and they're going to refer you to an athlete. And the first person that comes to mind when you meet with that athlete is Laurent.
I mean, it's certainly a pillar in, or almost like a pillar in every single one of the portfolios, because getting into the stock market and stuff like that, these are all things that are relatively out of your control, right? The stock market moves up and down. So everybody, be it a business owner or a professional athlete, they need something that's going to give them something that's steady, predictable in costs, predictable in revenues as well. And that's why a lot of people flock to real estate, right? And you look around, I mean, even in your networks, I'm sure that you would say, real estate in itself is the cornerstone of almost every wealthy person I've ever met. It's the cornerstone of their portfolio, of how they became wealthy. So definitely it's a question of making that introduction, because like an athlete, imagine being 25 or 26 years old, coming into a ton of money, and knowing that your career may have a lifespan of 5 to 10 years, depending on, physical and mental wellness. You need to make sure that your money can, not outlive your money. You need to make sure that you have cash flow that carries on beyond your retirement, so whether it's a business owner who's selling his company or not, or an athlete in this case, this is definitely something that we put in, because, like I said, it'll be able to continue paying them even after, or long after, they retire.
Laurent, how long have you been working with real estate portfolios?
Well, I mean, my family's been investing in real estate going back to the 80s. And then that was, in Texas. And then here in Quebec during the referendum, there was a big opportunity once the whole real estate market collapsed. And, Toronto, essentially, big reason why Toronto is so big today is because of that sucking sound that came from the referendum. And then after the 2008 crash, that's when we decided to go south of the border and invest in the biggest economy in the world. And we were finding unbelievable deals. The whole country was basically on fire sale. And that was our entry to the U.S. And in the last 10 years, we've built a pretty substantial portfolio in real estate. Before that, I was in the same line of work as Stephen was, and I wasn't able to do all the things I wanted to do, especially with the handful of athletes that I was in touch with. And real estate kind of became the gateway to that, where oftentimes I don't even meet the athletes, or I don't. You know what I mean? It's not really about that. I'm like with Stephen, I'm kind of a solutions provider, where, if their agent or if their money manager wants a piece of real estate but doesn't know where to look, I come in and I kind of facilitate that. Whether I'm involved in the interaction or not, I'm indifferent towards that.
So Laurent, obviously, we're talking real estate. We're talking a long-term investment, because you talked about the crash. And real estate could actually be down for a couple of years, but history has shown us that with time, it's always going to go back up. So we're talking long-term investment, correct?
Yeah, that absolutely, Tony. I mean, it's never a buyer's and a seller's market at the same time. And so what we try to do is come into different, pockets of opportunity when it is a buyer's market. And then, like I said, we buy and hold. And because the philosophy of our families is really to build generational wealth. I mean, they've made their wealth doing something else, whether it's a shipping business, or they sold a diamond business, or a professional athlete, or whatever it is. they're looking to preserve, not necessarily to hit a home run. I like to say our business is kind of like hitting singles and doubles. That wins games, and we're not maybe the sexiest bride, but we're a faithful bride, and that has an appeal to people who want to make sure that their families are taken care of for generations.
Stephen, one of the things you mentioned a couple of minutes ago was we can't control the stock market, and Laurent just talked about hitting singles and doubles and maybe not hitting home runs. But when you try and hit the home run, of course, you can strike out many, many times. Is the logic as plain and simple as with time, brick will always go up?
I think so. I mean, you also have to keep in mind, I think it's important to note that, you're buying real estate or you're co-investing in real estate passively, right? Because anybody, and we would encourage you to do so. I mean, you can go out and buy real estate, and many people have done really well doing so. But the advantage of doing it passively this way is obviously that, you don't have to take that phone call from your tenant at 2 o'clock in the morning that the toilet's busted or whatever else. It's really a calculated approach that you're basically leveraging the ability of coming in with a lot of investors and just collecting that rent without the headache of the actual maintenance of the building. So it's your way of introducing real estate to your portfolio without you actually having to take it on, which is why, again, the athletes love it, right?
Or for that matter, Laurent, you don't have to go out on the first of every month to go collect all the rents from all the apartments that you own. You don't have to do that either.
No, thankfully. And I mean, Tony, our portfolio is mainly in office. I mean, what we own is mainly, large institutional type portfolios of office buildings across the U.S. And our tenants tend to be Fortune 500 companies, Microsoft, Oracle, Daewoo, Merrill Lynch, you name it. And so their check is pretty good. It doesn't usually bounce. And we have, property management teams that take care of that. And so, like I said, there is an appeal in that it's a lot of the heavy lifting is done for the investor.
So obviously it's very calculated. You're not going to buy property or real estate all over the world and sometimes paying exorbitant prices. As you mentioned, you took advantage of a crash in 2008 to get some really, really good deals. So back in 2008 or 10 or whenever it was, and the dollar was at par, there were a lot of foreclosures. You and your people were going out and you were pouncing on opportunities that you knew would be great value for people going forward.
Yep, exactly. And they weren't even necessarily foreclosures, Tony. There, you'd see some of these assets. Oftentimes we buy prime quality assets at distressed prices. And the reason why is because their structure that they're caught in is distressed. The assets are in perfectly good shape, but these funds who own these assets, usually they're stressed out and people want their money out, and then they have to sell assets to inject some cash, and they're in a bit of a bind. But the asset itself, the underlying asset, is very healthy, and that's where we come in and given the market circumstances, we can get things at a very good price. And in real estate, it's all about the basis. And what do I mean by that is all about what are you paying per pound. Warren Buffett says, if you notice, we quote Warren Buffett quite a bit because we like his long-term approach. It's hard to go wrong when you buy $1 for less than $1. And really, that's in essence what our business is trying to buy $1 for less than $1. And in real estate, that's something you could do when there are certain inefficiencies in certain markets, or like I said, there's a bit of a disconnect. Like I said earlier, there's a bit of a disconnect in the real estate world between what's good for the fund managers and what's good for the investors. And so we kind of developed a little bit more of an investor-friendly approach. And the only way we could do that is by not tying ourselves down to some arbitrary term where we say, look, we're going to buy this and then we're going to sell it in 5 years. Who knows if 5 years is going to be a good time to sell? You think selling an office building in the middle of COVID was good for the seller? No. Was it good for the buyer? Yes.
Stephen, the investment, does it have to be, I would imagine it has to be a minimal amount, right?
Yeah, so I was going to say that, it's important to also mention that this is obviously reserved for accredited investors, which, there's a specific criteria, right? That's the barrier to entry. Otherwise, you would say, okay, well, why doesn't everybody get into it? It's not to say that's not accessible. It's not necessarily only reserved for, entertainers and professional athletes, but there are barriers to entry. So you would need to be an accredited investor in order to get involved. And then typically they start at around the $50,000 USD mark. And just so that you know, like in terms of how the order flow works, is that Laurent and his team are out there finding deals, right? They don't need to find a deal, but when a deal does come about, they'll then basically either scoop it up or put in an offer to buy it. And then the deal will be put on to my desk, right? And then it's my job to say, okay, based on this deal, which one of my investors or how many of my clients would like to get involved in this, right? So then we go through presentations, we run through the numbers, and if it makes sense, we invest, right? So that's just so that you understand kind of how the relationship works. They find the deal, then I present the deal to my pool of clients, and then we invest that way.
Laurent and his people have a specialty, and that is finding deals in real estate, and they scoop it up and they buy, like you said. You have a specialty, which is investing money from pretty much all across the board, all sectors of people. And at that point, those who are deemed investors, like accredited investors, like you talked about, when all these deals come on your table, you can pick and choose where you think your clients could actually make a good investment. Now, Laurent, you're buying all over the United States?
No, we're pretty focused. If you look at the map of where we buy, it's pretty much in the middle of the country. And that's absolutely by design. When I say the middle, all the way up from Minnesota down to Texas, Florida, a little bit in, Tennessee, Ohio, Illinois. The reason why is because, like I said earlier, this is really where the value is. These aren't necessarily the most liquid markets. What I mean by that is when you buy a certain real estate deal at that scale, when those go on sale, Tony, there isn't a huge buyer pool, even in the institutional world, for a 2 million square foot office portfolio in the suburbs of Kansas City. Just not many people line up to buy that. And so that's why you get good deals, because if you put an office building up for sale in Silicon Valley or in New York or in Miami, somebody will overpay for it in a second. And so our focus has been in that part of the country because we're not necessarily worried about having to sell it in 5 or 7 years like these other groups are. We're in it for the long haul. And so that's why we've built up a pretty substantial portfolio in a specific market or segment of the country. But that doesn't mean that if a good deal came up in Los Angeles, or like our deal right now in Houston that we're doing, Houston's a pretty what you call a gateway market, whereas we're used to investing in what you call non-gateway markets. The reason why is because the pricing was good. So we're not married necessarily to that portion of the country, although it is a great portion of the country. And anyone who's been there will know that it's good people from there. It's really because that's where the value is.
So, Stephen, excuse my ignorance on this matter, but a quick question here is that I buy into this real estate portfolio. I buy along with, I don't know, give me a number, 10, 15, 20 other people. Is that whatever?
In some cases, there's a certain minimum per, I should say, there's even a maximum that you can buy in per deal. And correct me if I'm wrong, Laurent, but I believe it was capped at a maximum of 20% per deal. So if they're raising, let's say, $60 million, any given family or individual can come in and buy up to more than 20% of any given deal. That is to avoid having excess control out of in any deal. Laurent, that's right?
Yeah, that's bang on. Anything over 20%, it gets a little bit complicated. We like to, as the real estate group, maintain control of what goes on. But it's more than 40 or 50 families, Tony. It's probably closer to 100 to 200, depending.
So perfect. Let's just say it's 150 families, all right? Mm-hmm. Yeah. And there are X amount of rents coming in per month. Mm-hmm. Do I have access, my share out of the 150 to that rent, or does it stay there and probably actually take those rents and probably put them into other portfolios going forward?
No, that wouldn't be very kosher. You can do that individually yourself. So we have investors. So the idea is good. You're right, is that you invest in a deal. You have 130, 140 tenants paying rent every month. Those rents are collected and they go towards paying down your debt, paying taxes and expenses, and then what's left gets distributed to the investors. And the investors literally get a paper check in the mail for whatever percent ownership you have in the deal. You get that same percent ownership in the income. And then, for a lot of our investors, this is passive income, meaning it's
Yeah.
not necessarily what they're using to buy groceries. And so they'll reinvest it in the next deal and compound and compound. And that's definitely a strategy to get rich. We always hear about getting rich quick, but there's nothing wrong with getting rich slow.
So, Stephen, those who would approach you and say, Stephen, listen, I'll invest in it, but I want to pull out my money 2 or 3 years from now, you're going to say this is the portfolio. This is not the portfolio for you, because you have to leave your money in there for, I would imagine, long term, X amount of years. How many years are we talking here?
Honestly, RMC has no intention whatsoever of selling the asset. So you need to be, if you have the ability to park money into this type of investment, you're parking it there with the intention that you just want the passive cash flow. You're not in it to get out, which is why, again, when we build portfolios, you have to build them with a mix of both, having stocks and things that you can actually sell if somebody does need liquidity, right? This is why this doesn't necessarily represent 100% of any individual's portfolio. You know what I mean? They would have stocks or other things that they can liquidate beforehand. But again, that's what kind of differentiates somebody who's an accredited investor. It means like the 100,000 that they're putting in is not necessarily their last 100,000 or their only 100,000 that they have to invest. You know what I mean?
Guys, I want to bring in someone else to join us in this conversation, because according to Sports Illustrated, 78% of former NFL players experience financial distress 2 years after retirement. And most professional athlete earnings are actually compressed into just a handful of years. So without further ado, he is a certified NFL agent and owner of an All-American Fundamental Showcase, Sean Stellato. How you doing, Sean?
I'm well. How are you guys doing?
We're doing extremely well. Thanks for taking time for us today. What can you tell us about these guys? Because you've had some of your athletes invest in the portfolio, have you not?
So we are actually in the process of that. So, and it's a great product. Bricks and mortar is a great area. My job as a fiduciary and being a confidant to clients and potential clients is to really educate them. Because you're right, there is a lot of horror stories about athletes going bankrupt, losing money. And let's face it, the average lifespan of a player is only 3.3 years. So they do have the platform that's not your traditional platform to your average person. And they get access to a lot of things. But at the same token, there's a lot of opportunities that come their way that might not be in their best interest, and they've really got to have people that can advise them properly, because at the end of the day, it's not how much money we make, it's how much we're able to keep and invest and obviously grow over time.
So as someone who's a certified NFL agent, you've heard the horror stories and you've seen the horror stories. Listen, it breaks my heart every time I hear someone who's made millions and millions of dollars not have any money left when all is said and done.
Yeah, because if you have that mindset of delayed gratification, or even if you're putting it in the S&P 500, over time. So, obviously there's riskier investments. When you're younger, your investment objectives are a lot different than when you're 22 compared to when you're 65, 70. But you talked about Buffett. I mean, buy good companies for the long term, and at the end of the day, if they follow that, but they can do well and have great lives, and hopefully don't be a statistic on the 3.3 years, because let's face it, football has one of the four majors, and if you're able to get to your second and third contract, that's where really the true money can be made. But at the end of the day, these guys are getting taxed at a high rate, and they have a lot of people that are coming at them with a lot of ideas, and obviously some of them want to take care of family. So after all said and done, you got to have that no person,
Yeah.
With Group RMC, they got I think a really viable product that I'm excited about, and having a finance background, I think it's going to be a great way for these guys to have exposure in an area where they can be educated in something concrete and solid, that they're going to be able to, persevere. I should say, preserve their money. Did I lose anybody?
No, we were, you were breaking up for a second, but we're all good. Sean, thanks for your time. And he's Sean Stellato, of course, who's a certified NFL agent. We'll talk to you soon. Thanks for doing this, bud. Thank you, Sean. All right. Okay. We was breaking up for one point there, but it's all good. Steve, do you find that when you talk to athletes nowadays, more so than talking to them 5, 6, 7 years ago, that more so now they're more aware, they're more educated, they understand more the difficulties that some other athletes have had because they too have heard the horror stories? Do you find they're more educated in that respect?
Well, listen, I think that goes for everybody, right? We're living in a time now where there's so much access to information, right? I think so many more people have become more and more financially literate, especially during the pandemic. I mean, people actually had time to sit down and learn about stocks and learn about the economy and read up on things. So yeah, I think athletes are no different. I think a lot of them have already seen, and I know that a lot of the veteran athletes have also started to pass down a lot of that wisdom. Don't do this. Don't buy that cheesy car wash that your buddy's going to have a great idea and, try and plug you into a bunch of restaurants or, some other type of get rich quick type of situation. And let's look at what really works, right? And when you boil it down, trends come and go, but real estate's it's there to stay. You know what I mean? So yeah. A lot of these guys, they have the opportunity in some cases to invest in the skyline of the city that they played in. You know what I mean? So like, if you can own a piece of that, wouldn't you own it? You know what I mean? If you know that you're sending your wife works in that building, you can own a piece of that building. Your kids are going to school in this area. You can own, a block in that area. So I think it became something that's very, very real. And I think that knowledge has been passed on because a lot of the guys are and girls are certainly, wisening up, smartening up, and they're asking the right questions, or they're surrounding themselves with the right people to find the opportunities that they need to make sure that they don't outlive their money.
Laurent, one of the first questions every investor always asks is, what is my expected rate of return? Based on the amount of time that you've been dealing with the real estate portfolios, is there a rate of return number that you can give us?
I mean, every deal is a little bit different. Our deals have, different profiles, I guess you could say. Some of them are a little bit more what you call value add, meaning they don't necessarily pay much at the beginning, but they're a little bit juicier a couple of years down the road. Some of them are a little bit more plain vanilla, but they pay up front. And some of them are home runs. It happens, when you do things right consistently for a long time, you get lucky. That's in any industry. So I would say I'll give you an example of a deal that we're going to launch in a couple of weeks here. It'll probably distribute somewhere between 5 and 7% on day one, and then with the opportunity to, when we lease up some vacant space, we'll refinance. And we'll get some equity out. So to answer your question, Tony, I would say anywhere long-term rate of return, probably anywhere from 10 to 15%, which is a mix of growth and of distributions.
And you know what I love about this, guys, especially if you're a high income earner, let's just say you're an athlete making millions and millions of dollars per year. As Sean just talked about, they're getting asked for favors by everyone, their entourage. Buy me a house, buy me a car, help me out. I used to go to school with you. I used to protect you from getting beat up. I used to do this. I used to go shop for you. I used to buy your clothes. I was your best friend, yada, yada, yada. All of a sudden, if you start taking money out of the bank here, money out of the bank there, money out of the bank here, money out of the bank, there's no money left. What I love about this, it actually limits the amount of cash that's still in your bank account, which I think ends up, in this case, being an advantage, right?
This is a pay yourself first situation, right? Like you said, it's almost it's a blessing in disguise. That whole illiquidity factor that Laurent brought up before, it's a blessing in disguise because it's protecting you from yourself. You know what I mean? It's protecting you from saying, "Oh yeah, I do have that extra scratch to put into your car wash or whatever else." Yeah. Oh, no, sorry, actually that money's already been allocated. Sorry, I'm working with, I have just enough to put my kids through private school. I don't know. You know what I mean? Like you have to pay yourself first. And it's a lesson that a lot of these people learn. It's like the money comes in, put it to work, because there's nobody else that's going to be working for you when you retire, so make sure that it's working for you.
Steven Furtado, investment advisor with Manville Private Client, and Laurent Massa, VP Family Office and Advisor Relations, Head of Sports and Entertainment Division at Group RMC. If somebody wants to get a hold of you, I can give out the website, of course, for grouprmcusa.com. Other than the website, is there a number where they can reach you, gentlemen?
Yeah, absolutely. I mean, listen, I could be reached at 514-458-8173. If you guys want, you can put it up on your site. And I think this is something that maybe I'm speaking too soon, Laurent, but in the event that you guys want, or if there's interest from the audience, maybe on a next raise or a particular opportunity situation, we can gladly invite some of the audience that fit the criteria as accredited investors to come in and attend and actually see what one of these raises are like, so they can reach out to you guys directly and you guys can put them in touch as well.
Steven, that sounds awesome. Laurent Massa, closing comments by you?
No, I mean,
Steven said it well, huh?
he said it well. How do you follow that? You know what? When we launch a deal, there's obviously people are pretty thorough, when investing that kind of money, and so we do have quite a bit of lead up going up to the actual fundraising. We host webinars where we walk people through the deal, we educate people on the story of the deal, why it's up for sale, why it's a good deal, what our strategy is, and so if members of the audience do want to participate in that, then we're glad to loop them in the process, and then they can make their own decision if they think it's a good fit for them or not.
Always heartbreaking when you hear that someone's hard-earned money actually is no more. And with gentlemen like this and the work that you do and the great professionals they are, you don't have to worry about that going forward. So Steven Furtado and Laurent Massa, thanks guys for joining me today on the SIG Podcast.
Thank you, Tony.
You can listen via the iHeartRadio app or follow us on the SIG Podcast on all social media platforms.